Hello, and welcome to today's webcast, Identifying Opportunities in Emerging Market Equities, sponsored by Harbor Capital Advisors and Oaktree Capital Management. Today's live webcast has been accepted for one CFP, one CIMA, and one CFA CE credit. For questions on credit, please use the number on your console. Additional material can be found in the Documents folder at the bottom of your screen. We also have a brief survey which can also be accessed at the bottom of your screen. Our speakers will be taking advisor questions. Please type your questions in the box to the right of the slides. We'll get to as many of your questions as possible. If you're interested in a one-on-one meeting with Harbor Capital Advisors and Oaktree Capital Management, please click the one-on-one folder at the bottom of the screen and confirm the request. A replay of this webcast will be made available. All registrants will receive replay information by email. With that, I'd like to turn it over to today's first speaker, Tori Pellegrini, Vice President for Research for Harbor Funds Distributors. Tori?
Hi everyone, thank you so much for joining us today. We appreciate you taking the time out of your busy schedules to attend this webinar. We have a really strong agenda lined up for you all today that I'm excited to take you through. We'll be introducing you to Oaktree's Emerging Market Equity team and have them talk through with you their thoughts on the asset class in general, outlook moving forward, and where they're finding the best opportunities. My name is Tori Pellegrini. I am part of the Key Accounts Research team here at Harbor Funds, and I'm joined on the call today by Frank Carroll, who is a Managing Director at Oaktree Capital Management. Frank is also the co-portfolio manager on Harbor Emerging Market Equities Fund. Before I introduce you all to Frank, which I'm very excited to do, I'd like to first just provide you with a bit of background on Harbor and our relationship with Oaktree. Harbor's been around just over 30 years. We're a bit unique in that we do not have an investment team that manages each one of our funds. Instead, we have a team of researchers that's tasked with identifying best-in-breed institutional asset management firms and partnering with those firms to make their best strategies available to the RIA, retail, and retirement plan space in a low-cost mutual fund wrapper. Harbor doesn't work with just anyone. Each of the sub-advisors that we hire, including Oaktree, has undergone a very thorough due diligence process that typically takes several years. During that time, our team takes a deep dive into all aspects of the organization, including certainly the team that's going to be managing assets within the organization and their backgrounds and track record managing within that space. If you look at Harbor's lineup today, we believe it represents best-in-breed managers in every asset class, and that the managers we've chosen are the best at what they do and the best at how they do it. This includes Oaktree, who I'm excited to talk to you more about today. Harbor's relationship with Oaktree begins back in November 2013, when we decided to hire them to manage the Harbor Emerging Market Equities Fund. Oaktree has managed this fund since its inception in 2013, so Frank and his team own the entire 5-year plus at this point track record. Worth mentioning as well, the fund is managed as part of Oaktree's institutional long-only EM equity composite. That composite actually predates the fund, so its track record is even longer. From a style perspective, the strategy is value-oriented and very pure to the EM universe, especially when looking at this fund compared to many of its major competitors within the space and this asset class in general. It's a high conviction portfolio. It typically holds between 60 to 80 names, and in general it's had a turnover of roughly 40 to 60% on average. Harbor's retirement share class, which is the least expensive that we offer, is available at a net expense ratio of 1.08%. With that, it's my pleasure to introduce you all to Frank Carroll. Frank, we've been tasked with covering several objectives on the call today. I'd like to start just by having you give some background on Oaktree, your team, how you manage the portfolio, and from there we can transition to outlook and talk a little bit more about where you're finding opportunity within this space. Does that sound like a good agenda?
It does. Thank you, Tori. Thank you very much. Thank you, everyone, for taking the time to be on the call this afternoon. I appreciate the attention. We certainly have been very happy and honored to be partners with Harbor in this endeavor, and we've enjoyed the relationship, and we're glad to see that it's continuing to grow. So, thank you again to all involved in all of that. It's also kind of exciting times. Maybe I'll lead with this. Emerging markets is certainly in the news, and we're already starting to get in some questions on the usual topics of China, et cetera. So I think that this could be I hope this will be an interesting hour or so for you folks, and we'll kick it off. Oaktree, founded in 1995, publicly listed, ticker OAK. You might have seen recently that we are eventually going to merge ourselves or be acquired by Brookfield Asset Management. In the meantime, we will run independently as a firm, and any sort of change to that would not occur until in the mid-2000s. So at Oaktree, it's sort of business as usual. We are a global alternative investments manager. We are active in distressed, in high yield, in loan products, in private equity and real estate. And then, as you've heard, most of those are, of course, credit strategies. I like to call the EM equity business the hidden gem at Oaktree. I like to call it that. I'm not quite sure what my partners call it. But nonetheless, we are part of a global footprint of Oaktree, as you could see on this page, where we have offices around the world, a presence around the world, and lots of global resources that are accessible to the emerging markets equities team. The way I typically describe it to clients is that we get the opportunity to run a small boutique with big firm resources. A bit about myself and my partner, Tim. I co-run the emerging markets equities business with Tim Jensen. We've each been doing emerging markets equities for about 30 years. Today, actually this day, marks my 20th anniversary at Oaktree. And Tim has been here 19 years, so we have quite a long tenure at Oaktree. I think there's a few sort of parts of that make us perhaps a little bit different. One is certainly we have a very long tenure in emerging markets, and we've seen emerging markets come and go and develop and perhaps undevelop over time, and we've seen lots of investment cycles in it and have a lot of experience between ourselves and the team. The second thing that I think is worth pointing out is that we come from a hedge fund background. In our early days at Oaktree, in fact, when we joined Oaktree and set up our initial product, we set up that product as a long-short hedge fund. And there were a couple of reasons that we did that. One is that we think the macro in emerging markets is very hard to predict, and so we weren't trying to predict the macro. Even today, and I'll elaborate on this a bit more as we go on, we're very aware of the macro, but in my 30 years, I haven't seen anyone consistently get the macro correct. So and that's really an Oaktree tenet. What that means is by portfolio construction, we construct the portfolio from the bottom up. We are individual stock pickers, and then Tim and I will have an eye on the risk around that portfolio construction. As Tori mentioned, the portfolio is typically concentrated in, it's really been more like 60 to 70 names more recently, but has ranged from 60 to 80 names over time. We, if you, again, thinking about that background and thinking about that team, to summarize, we are aware of the macro, but we are really trying to add value from the bottom up. I think what's also interesting when you come from a long-short background is there is no benchmark in the low net long-short hedge fund world. And so our analysts have been tasked, and they are global sector analysts. They have been tasked with going out and finding the best opportunities in their space, period. We don't build the portfolio from the benchmark up. We simply use the benchmark for portfolio construction because we are most certainly trying to outperform the benchmark. The roots of the long-only strategy come out of that hedge fund team. That hedge fund team did very well. In fact, in the 2000s, We didn't have a losing year, and investors were very happy about that. For those of you who've been doing emerging markets equities for a long time, would remember those as really the really good old days when clients would come to you and say, hey, Frank and Tim, that's really wonderful. We like what you're doing in the hedge fund, but we're in EM for the beta. Don't pay hedge, and we want more beta. And we would tell them, don't pay hedge fund fees for EM beta. Get yourselves a good long-only manager. And those conversations evolved to where in 2011, we decided to go ahead and launch this long-only product that now has this roughly 7-year track record. It has been pretty much the same investment team and certainly the same Tim and me for most of our history here at Oaktree. From an investment approach, I would say that we have three core principles. One, as I mentioned, the fundamental analysis, which is really doing the company work. We look for companies with strong cash flows, attractive returns on balance sheet, on their capital, and strong balance sheets. We like to see that they are doing the right things with the capital that they're generating. We're certainly happy to see them give it back. We certainly like CapEx discipline. We meet the managements. We build our models. We've done this over very long periods of time. Internally, we run about 425 models from which the 60 names in the portfolio will fall. And, of course, the management meetings, et cetera, and travel are all part of the EM game. Our analysts are global sector analysts, and again, that is by design. We want them to take the knowledge that they learn about their sector in one market and apply it to another market. And oftentimes, there really are lessons learned on whether it's a consumer curve or a banking or financial services penetration, et cetera. What one learns in one market can be learned in the other. And that also kind of complements this idea that we think the macro is really hard, and so we shy away from having country or regional analysts because we don't want them to be making an implied regional or country view. What this allows us to do is to examine the opportunities across the globe and then decide where to best allocate that capital. So if our energy analyst is not finding any opportunities in China, then so be it. Perhaps there are opportunities in Russia and India and Brazil, somewhere else in the world. So we're not trying to be everywhere at all times. And then lastly, we are very aware of the risk. And that is, I would tell you kind of tongue-in-cheek, that the best risk management is frankly to get the fundamental research right in the first place. So that is really where we focus. We focus on making sure that we have done the right work on these companies. We have been covering most of these companies for many, many years. We have very deep relationships with these companies, and we've seen them through investment cycles. We've seen them through economic and political cycles, and we build a history with them. We do the work, and then we're basically ready for the pitch. There's a lot of volatility in emerging markets, as you all know, and if you don't like the price today, maybe wait a few days, and the price could actually come your way. We've been a little bit more stable recently, so it's a little bit longer than a few days, but there have been periods over time where prices do change quite a bit month to month, and we just want to be prepared. We want to be disciplined, and we want to have done the work so that we can withstand the inevitable volatility of the emerging markets.
Frank, this is Tori. I think it's very interesting that your team has a background in long-short, and it's one of the things that certainly makes you very different to some of your competitors within the space. The other thing that I think is a big difference is, and you mentioned it just now, is you do keep in mind price as part of your investment process. And when you look at how the fund's performed stylistically, it's clearly value side of core. Why do you think value investing works in this asset class? I mean, when people think emerging markets, I know a lot of times they think growth. Companies like Baidu, Alibaba, Tencent, who are changing the way that people interact with the digital world and with each other. Are these quote-unquote, value names that you're investing in, aren't they just boring, steady cash flow businesses with limited growth potential?
So yes, actually, we kind of get that a lot. And if you look at emerging markets performance, equity performance over the last 30 years, for most of the time, value has actually outperformed. There's a very brief period from 2015 through 2018 where growth had outperformed, and it was definitely a bit of a headwind for our strategy. But over time, value has been the more attractive, has been the better performing characteristic in EM equities. And there's probably a couple reasons for that. I think for the last 20 years, people have gone and invested in emerging markets or had portfolio allocation to emerging markets because of the growth. And so if everybody's allocating to EM growth, that tends to be in the price of the EM stocks. And so we just haven't found the margin of error or the valuation protection on the growth side as wide as we would like it to be. And of course, on the other side of that, a lot of the value names have been out of favor. And value really can mean all sorts of things. I want to be fair about a definition of value. Value to us really means that we're buying something for less than what we think it's worth. We own Tencent today. We were lucky enough, for example, to have owned it early on in our strategy, and then we were out of the name, and then it became cheap again in the macro and China trade war noise, and it gave us an opportunity to add the name back into the portfolio. So we're not going to completely ignore a higher PE or what might be considered a growth stock, but the majority of the portfolio is definitely made up of value names. And where's the value in EM today? The value in EM, a lot of it is because you've had 5 or 6 years of the last 5 or 6 years, really since, actually it's probably more like a decade, since the global financial crisis, the EM markets have been under pressure. You had a stronger dollar, you had a lot of big macro situations in Brazil and China, you had a lot of noise, and you had a really raging U.S. stock market. So it was really hard for EM companies to access capital. And they definitely had more leverage on their balance sheets coming into this than, I'm sure that they would have liked now in hindsight. But so what have they done? They've been cleaning up their balance sheet. We've seen our companies delevering. We're seeing increasing dividend payouts. We're seeing improving cash flow, which is leading to better dividend payouts, leading to stock buybacks, and leading to a revaluation. The amount of delevering in the balance sheets of EM corporates is off the charts. It's really, really phenomenal and impressive what they've done. I would add to that, if you looked at the characteristics of our portfolio, ex-financials, about 3/4 of the names we own are net cash. That's not because Tim and I told our analysts to go out and find a bunch of net cash investments. It's because really looking across the space, there are so many of those names to choose from that they chose from the best of the net cash investments. So we have a really strong portfolio on the value side of it that has largely been ignored in EM.
Well, it's exciting. It seems like there's a lot of exciting things happening in the space in general, which I think this would be a good time actually to pause, and we can take a quick poll of our audience here just to see right now, for those of you that are considering or are already invested in emerging markets, how many of you are investing exclusively in active, exclusively in passive, or some combination of the both. I think it would help give us a little bit of perspective on one of the big industry debates that's taking place right now. Certainly on the domestic side, I think a lot of us are very familiar with the fact that within something like large cap growth, the preference over the past few years has trended towards passive. We can talk a little bit about, as soon as the responses come in, where we see that trend going on the emerging side and whether it's the same or whether it's slightly different. So if you could, please enter in one of the selections, and we'll hopefully give you some commentary here. Tim, Frank, what have you seen take place from a flow perspective? in terms of this debate, specifically within the emerging market space?
So admittedly, over the last couple of years, we've definitely seen more inflows into the passive side of the business. I think, frankly, some of that reason is that there were, I think, institutions in general had been underweight emerging markets equities for a very long time. And my gut is that the first reaction was I need to get EM equity exposure almost as quickly as I can. And so the easiest first move is to go into the passive space. And so I think we've seen that. So the flows are probably split these days between active and passive. And flows themselves in emerging markets have been a bit volatile. Last year was a good year. This year we're off to a good start. But we've had a couple of rocky years in there also.
Well, let's see how our participants voted here. Interesting. So it does seem there is a preference for active relative to passive, but clearly most people using both to some degree or another. Frank, do you think this is a wise decision? Do you agree with the results that we're seeing here? The other thing that I think has to be a factor is active management in any space, but particularly in this space is not cheap. So why should somebody consider investing with an active manager instead of going out on the open market and paying 15 basis points to buy an ETF? So let's talk about some of those things. What are your thoughts?
Sure. First, I want to comment on the poll. I love all of you, so thank you very much. I'm so relieved to see that active and both was able to beat passive, at least in a market which probably has, of course, the bias towards active, but thank you very much. Tori, look, let's be honest, a lot of active managers, and I do think more so in the U.S., where it is definitely harder to add value active investing than it might be in other markets. That I think in European equities and emerging markets equities, I think there is still there's enough volatility, there's enough political noise and macro noise, there's enough conventional wisdom that quickly comes to conclusions that China's going to hard land, China's going to soft land, China's not going to land, China did land, etc. There's enough of that noise going on that I think an active manager from the bottom up can add value. And, if you sort of think about this whole debate of active versus passive, and I'm stealing some of these thoughts from one of Howard Marks's memos, because I think Howard said it really well recently in a memo where he basically said, is it a good idea if you build a portfolio with absolutely no regard for company fundamentals, security prices, or portfolio weightings, which is in effect what a passive manager is doing. So which also means for that low fee, you're kind of getting what you're paying for. But as the active manager, I would take the other side of that and say that the wisdom of passive investing comes from the belief that the efforts of active investors cause assets to be fairly priced. That's why there are no bargains to find. So if you don't have active managers doing price discovery and doing the heavy lifting of the securities analysis, etc., on the companies in the benchmark, then you don't have a very efficient benchmark. And so the only reason the people that set the weights in the index that the passive managers buy are the active managers, because they're the ones who vote with the fundamental background. And so I think in a lot of ways, passive can only go so far, and I'm not sure that it could really exist without active managers to do the work to set the prices and to help determine fair value on an individual company basis. I'd also probably say, and I should be careful what I wish for, but it doesn't really bother me that so much money is looking passively instead of actively right now, or at least according to all the press headlines. Because again, that means that there's more and more people pushing security prices without regard to the fundamentals, which means that they're creating inefficiencies that a good, talented, bottom-up active manager should be able to capitalize on. So to me, that's a bit of an opportunity.
And Frank, feel free to agree. Sorry, I didn't mean to cut you off. I was going to say, feel free to agree or disagree with me, but I feel like another important aspect of investing in this space is trying to avoid some of the potential pitfalls, which, clearly that's a benefit of having an active manager. A question that we always get is how important is corporate governance to investing in emerging markets, and how is that governance changed over time? I mean, along the same lines, there's definitely a perception that within the EM, things are less regulated and less transparent than the developed markets. It's almost like, the Wild West for equity investors. How do you go about navigating some of those hurdles and pitfalls and making sure that management teams are acting in the interest of the shareholders?
So, honestly, it's funny. I think EM gets a little bit of a bad rap in terms of our managers being more like the Wild West. If you look and that's not to say, by the way, and I'm going to come back to answer your specific question about governance. It's not to say that governance doesn't matter, but I think EM companies have done a very good job of cleaning themselves up. If you look at a lot of the so-called frauds or trouble that came out in the global financial crisis, they were more in the U.S. companies than they were in the emerging markets companies. So I actually think collectively we probably did a better job. But having said that, and you touched on something interesting there, Tori, which is at the end of the day, our job is not only to pick winners, but it's to avoid losers. And that's an interesting part of our background because that hedge fund background, our analysts, I think, are a little bit more skeptical in nature because they've been trained to look for something that they could short also. And I think that they're trained to avoid losers, to avoid that trap. And, if you don't own a name and it's a big part of the benchmark, you're effectively short. We've been shorting for many years. So our analysts are looking for that opportunity to avoid a disaster, to avoid a loss. And just to quickly touch on the analysts before I move more into into the governance question and about how we really handle the governance, you could see the team on the slide that's up there. Myself and Tim as co-portfolio managers here at Oaktree for quite some time. Nothing gets in or out of the portfolio without us approving it, so we are the trigger pullers. We are supported by a team of 9 analysts by sector globally. We have a pretty diverse geographic setup across the team. We have a pretty diverse language and other skill set background behind the team. You can certainly see the tenure at Oaktree for a fair amount of them is quite long. And I think that's an important part of our strength is keeping together a very good team that really works well together, helps each other, and in some ways feeds off of each other. And so we're proud of that team. And then lastly, to mention it because it's on the page, we have 24-hour trading because these are emerging markets. There are quirks across the markets that we invest in, and having long-term experienced traders that can help us execute has been a very important part of the growth of our business. As for that governance question, more specifically, we very much care about governance. But governance, governance not so much in a black and white that we want to avoid really bad managements, because obviously we certainly want to do that. And there are any number of generally families that control companies across emerging markets equities that we would not invest in. So we have certainly a kind of an avoid list, if you will, without naming names here. But governance in terms of the companies doing what they tell us they're going to do is very important to us. We also want to see better alignment, which we are starting to see across emerging markets. We are seeing more and more often companies, the company management, the C-suite, their compensation, a component of that will be the equity price. That's very new in emerging markets, and we really appreciate that because that's aligning our interests. I can also tell you, having met with these companies now for 30 years, a more recent conversation is companies asking us what can they do to get the stock price to go up. What do they need to do better? What kind of transparency do we need as investors? How would they like to see us to How would they like how would they like to allocate the capital? How would we like to see that? So the management and the governance is better, and they're much more engaged. I could also tell you they're much more professional. In the old days, it was the Wild West. You would get a lot of information from a Chinese or Korean company just because you showed up in their office. They were so happy to have you there that they would just start talking. They've become very professional now. They understand Reg FD and the stock exchange regulations just as well as any other company around the world. So the simple advantage of showing up and meeting a management, I think, is gone in emerging markets. I think it really comes down now to more continuity and history and experience. One of the tools that we use to follow this is we have an internal blog. That blog has existed for, I think, 15 years now. Over the last 10 years, there's more than 50,000 proprietary research comments on that blog from our analyst team, most of which represent interactions with our companies. So most certainly the 10-year-old comment isn't as valuable as 6 months ago. But if you think about that history that we have with the companies, we have a great way to effectively track that the company does what they say they're going to do. I'll be honest, I'm a bit cynical on this idea that I can ask a company management what the orders look like for the next 6 months, and they're going to have any better view than we are. Because we live in a world of just-in-time inventory. We live in a world of very hard-to-predict macro. I haven't met anybody that predicted both President Trump and Brexit. So I think the macro is very hard, and that goes back to why we try not to predict it. But we can get to know a company. We can get to know the management, the strength of the management. They can lay out a plan for us, and we simply want to see that they execute on the plan that they've laid out for us. That's extremely important for our comfort of being long-term investors.
Frank, as you said, the emerging markets is a big space with a variety of political and economic cycles going on across countries simultaneously. I know you just touched on the macro, and you're not trying to predict anything from a macro perspective, but can you give us some insight into how you're navigating the macro or political and economic environments that are going on and the risks associated with these?
Sure. In a lot of ways, that's the exciting part of EM. That is that macro or that disparity. We have countries that are at all at different phases, frankly, of their economic or political cycle. We have an election coming up in India. We've just had elections in Brazil and Mexico. In many ways, these have all been somewhat controversial and surprising, and those will create volatility and opportunities investing there. We have, in terms of economic cycles, Brazil is coming out of the worst recession that it's ever had. When you come out of a very, very bad recession, it means the banks weren't lending. If the banks aren't lending, they haven't created new NPLs, new non-performing loans. And so therefore, when we actually look at the bank balance sheets in Brazil, they're inexpensive on valuation because of the last, sort of recession / crisis / political turmoil in Brazil. And their balance sheets are clean because they don't have a lot of NPLs because they weren't lending to create them. So it creates an opportunity there. On the other side of that spectrum might be perhaps India, where India came out of a very big lending phase and has a rather bloated balance sheet among the banks of non-performing corporate and local debt. The Indian government has been working very hard to help change the regulations and push through regulations that will allow this debt to get cleaned up. And we've been doing a lot of work on the Indian banks, for example, to see which banks might emerge from this first. And, so there are examples in that economic cycle across the world. China is a more interesting one. Everyone is convinced that China has an enormous NPL cycle. We are somewhat more sanguine on China because we haven't seen, and again, if you go back to our blog, we've been discussing these with the banks for the last 10 years. And the banks are publicly listed on the Hong Kong Stock Exchange, and the Hong Kong Stock Exchange is very tight on their rules. And the banks have told us an NPL story, and the banks have basically delivered on the NPL story. But it's very easy for conventional wisdom or the press to say that China is going to blow up because China has a lot of debt. And I'm sure that we'll circle back to China in a bit of my outlook in some of the Q&A. Maybe I'll just touch briefly on the slide and on our risk management and diversity of the portfolio. I'm lucky enough, I guess you could say, to have the portfolio running in front of me live 24 hours a day. Tim does too, both home and at work. We're watching live updates to the portfolio. We're watching the updates as the traders are executing orders. We can watch the updates in pricing and news. From a risk point of view, we limit our country risk to no more than 1,000 basis points plus or minus the country's weight in the benchmark. So, for example, China today is around 30% of the benchmark. You could expect us to range between 20 and 40%. By industry, those ranges are 700 basis points. And so, therefore, you could expect us to, range on a 10% industry. We could be anywhere from 3 to 17. The reason that we use these guardrails is because, going back to that value bias that we have, we also want to make sure that we avoid a value trap or that we avoid over-concentration of risk and do get overwhelmed by a macro that we can't predict. So these have been guardrails that we've lived with for our entire 20-year history, and they give us enough leeway to add alpha, and they have protected us from getting overwhelmed by a country or, I think, at times being early. The other flexibility that they do allow is that if we don't find anything to do in a country, for example, Malaysia, the Philippines today, we don't have to be there. That's a bit of a side commentary on this idea of investing with the macro, which is, typically speaking, when the whole world loves a particular country, we find that the equities get very expensive there because, of course, everybody loves it. And without being purposely contrarian, take examples of Brazil and Russia and China, the biggest markets in EM, over the last 4 or 5 years. They've been very much out of favor. A lot of it for self-inflicted issues, particularly in the case of Brazil and perhaps Mr. Putin in Russia. But when you have such a macro headwind against or a view that these countries are almost uninvestable, it automatically causes the equities to get cheaper and more attractive, and it gives us an opportunity to look. When everybody knows a certain news item, we tend to believe it's in the price. So we're not going to invest on the headlines of what's good or what's bad. Once that headline hits, we believe it's in the price.
So it sounds
I think
to
you
me,
have a polling question.
Yeah, I was gonna ask. So it sounds to me you're very optimistic economically and politically on many of these EM countries. I do want to get your take on how you think that is going to translate to stock price performance within some of these markets. Before we do that, let's go to the polling question. I think let's have the audience make their predictions. How many of you think that emerging markets will outperform the S&P 500 over the next 5 years? I know, if we'd asked this question 10 years ago, Frank, it probably had be a much different story. Where I know, from your personal experience, people tended to try and avoid beta within the emerging markets 10 years ago. What do you think we're going to see from this poll?
Well, I think EM's definitely become popular again. So I'll be kind of surprised if you all don't think EM, I'm not trying to skew the poll here, and perhaps I'm talking my own book. Maybe this is a good opportunity for me to mention that I have a fair amount of my own personal money in this Harbor Fund. So I am investing right alongside all of you and your clients. And my investment committee, of course, consists of my wife and kids. So, I go home to a portfolio review pretty much nightly. So my money's where my mouth is in terms of EM equities being, I think, a very good opportunity right now.
Well, let's see how we did here. Well, it looks like the audience tends to agree with you, Frank. What do you think?
That's good.
Why or why not? And what are some of the factors at play here?
Yeah, well, hopefully you're all not just being polite, but if you sort of look at the backdrop of EM equities and the starting point, everything always starts from valuation, right? What price are you paying? So if you look at where EM equities are today, even with the rally this year, we are still at a very big discount to the S&P over the last 7 years. So that's the first thing I would say. The second thing I would add to that is that on an absolute basis, we're cheap to our own historical multiples on both price to book and price to earnings, and I would argue that the free cash flow is better now than it was 5 to 7 years ago. I would also say that we're at 20-year lows in capex to sales pretty much across emerging market countries. That's a really remarkable statement. So the companies are really showing discipline. And when you look at our individual portfolio, and I believe the metrics are on the Harbor website, we trade cheap to those two multiples that I just mentioned, our portfolio. So our portfolio trades at a discount to those overall measures. The second thing is the Fed's on our side. The Fed definitely turned more dovish late in 2018. They've been pretty well behaved here in 2019. Clearly, President Trump and his administration doesn't want to see the Fed taking away the punch bowl. I think that we're obviously in the third year of a presidential cycle, which is typically pretty good for the economy. And if the economy could just kind of chug along and the EM companies continue to do the right thing, there's a lot of room for upside there. The other headwind that emerging markets has had over the last decade has been the strong dollar. I think that the dollar peaked sometime in 2017, really, maybe in 2018. And if we're not going to be in a tightening cycle where the Fed's raising rates, then the dollar probably stays where it is. And if you look across most EM countries, our currencies are either undervalued or deeply undervalued based on purchasing power parity measures. So weakness in the dollar, or at least not strength in the dollar, would be another very nice headwind or would be a nice tailwind, for EM equities. And then, lastly, and this is still a little bit of anybody's guess, this is maybe a two-part comment I would make here, is I don't believe that the U.S. and China want to go into a trade war. I think both sides, particularly the U.S. side, have softened their rhetoric a bit. And if they were to go into a trade war, it'd be really bad globally. It'd be very bad for the markets. And I think Mr. Trump runs CNBC or whatever his favorite news network he runs the ticker in his office at all times. So he has a very keen eye on the stock market and stock market performance. Since sort of the detente, if you will, in the end of December, beginning of January, we've definitely seen better performance in U.S. and EM equities on the back of a hopeful trade war or trade tariff resolution. That would be a really strong push to emerging markets. And within that, the trade turmoil has caused China. If we were speaking 2 years ago, I would have told you that China was doing the right things. China was tightening up the money supply. They were forcing banks to clean up. They were trying to control the property markets from getting out of hand. They were trying to take excess capacity out of state-owned enterprises. China was doing all the right things. And I still believe a lot of those are the right things. But China thinks in much longer term than we do. And so they've been able to now, particularly at the end of the beginning of this year, they've taken their foot off the brakes a little bit. And they're allowing some stimulus back into the economy. And we see this when we're talking to our banks, where our banks have basically been told that it's okay if they do a little bit of lending again. We see this when we're talking to our state-owned enterprises on what their dividend policies and cash return can be. And so we're seeing the Chinese companies and the Chinese government do a lot of good things, which is really very constructive for emerging markets. And so I'm pretty excited about where we are in EM.
And Frank, it looks like this is translated to a relative overweight to China versus the EM, the MSCI EM index. Are there any other countries or sectors that you like or don't like and that you'd like to highlight for everyone?
Sure. I mean, I think maybe the two places where we might be considered a little bit different is that we have a substantial overweight to China. As you could see, and let me get to the slide to help you out here. As you could see in this slide, you could see our top 10 countries, and you could see there that we're about our maximum. We are our maximum overweight in China today. A fair bit of that, I should add, has come from performance. We were big buyers of China in the fourth quarter. China is by far the world's best performing market, and so our performance has helped to increase that overweight. The next overweight probably worth mentioning is Brazil. And again, the political noise and the Petrobras scandal, et cetera, in Brazil has caused a pretty big sell-off there. So that's allowed us the opportunity to build what we think a very attractive portfolio in Brazil. The other side of that, and this is, India has been the world's favorite market for many years. And we're underweight because when it becomes the world's favorite market, stocks get a bit more expensive, and we just don't find as much to do there. India has been a laggard market over the last 6 months. They're going into an election period in April, May here, and it'll be a big sign for Mr. Modi's ability to govern and push forward his agenda in the future. So we have an eye on the elections. We're doing the work. We would see probably any volatility or any sell-off, any politically led sell-off probably creates an opportunity for us to be looking at Indian names. But for now, we're generally comfortable with our underweight there. And then lastly, and again, because it's traditionally controversial to point out, we do have an overweight in Russia. We are aware of the political situation. We are aware of the sanctions, but we own world-class names in Russia that we think trade at basically 50% of what they would trade at if they were listed in any other market in the world. So there's a very big, heavy Russian discount on it. It's also interesting to note that Russia, because of all of that, because of the growth and strength of China and the recovery in Brazil and the growth of India, Russia has really become a much smaller part of our benchmark over the last 7 years or so. And then maybe if I flip back a page, the last thing worth mentioning perhaps on where we're putting capital to work, as you might expect from value investors in a low-rate environment, we have our biggest overweight is in financials, and our biggest underweight is in the more defensive names like the communication services, telecoms, and industrials. The real estate exposure, that's an interesting one in EM. For us, that's meant traditionally mostly the Chinese property names. We actually do have exposure there, and they've been very big winners in the overall portfolio, but we're not quite benchmark weight there.
And Frank, we're coming up on 10 minutes to the hour, so I've found this conversation personally very thought-provoking, and I hope our audience has as well. I just want to be aware of the time we have remaining and make sure that we can cover all of the questions that we've been asked. I know there's quite a few questions that have been rolling in here. Any final remarks that you want to leave everyone with before we open up to questions?
No, I don't think so. Thank you very much for the time. I'm actually kind of excited about the questions, frankly, because that really gives me a sense of what people are thinking about, and perhaps it'll skew some of the way I'm thinking about the markets or tell me where I might be looking for opportunities.
Well, Natalie, then I'll turn it over to you, and you can talk to us a little bit about how to submit questions, and I will kind of walk through questions one at a time, and Frank and I will answer them for you.
Great. Thank you both for such an informative presentation. As a reminder, additional material can be found in the Documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your question in the box to the right of the slides. We'll go to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Harbor Capital Advisors or Oaktree Capital Management team will reach out to you directly. If you would like to have a conversation to further discuss the ideas that were covered during today's event, please click the one-on-one folder at the bottom of your screen and confirm the request. With that, I'll hand it back to you, Tori, for our first question.
Thanks, Natalie. The first question that we have is, I feel like EM swings with global demand and risk appetite. Do you see the risk appetite returning? It's been difficult making a case for EM or foreign in general with clients over the past 5 years. Frank, how would you answer that?
Yeah, I completely agree. Boy, don't I know it. I feel it every day. I think that's exactly right. I think EM has been out of favor for quite some time. And so there was really no risk for EM. And again, all of the headline reasons why one wouldn't invest in EM, China, the dollar, et cetera. You're actually, I think based on some of what I've outlined, we are definitely seeing a return of risk appetite and definitely a much bigger interest in EM. I think it's okay to say that our strategy here at Oaktree, we've seen pretty impressive inflows over the last 18 months, and we continue to get invited to searches. For me, it's really simple. If a lot of clients want to speak to me, then obviously I know they're interested. It's self-selecting, because if you're not interested, you're not taking my meeting. And our dance card is pretty full these days with clients that are very interested in allocating or either coming from no allocation or topping up their allocation to EM equities. And I think there's a little bit of the FOMO right now. There's a fear of missing out because the markets continue to run. We've all, including me at times, I wouldn't mind a little bit of a pullback. But my experience is when everybody's waiting for the pullback to buy, you don't get the pullback. And as long as we don't get a very big macro headline in a trade war, and I'm not in the camp that the U.S. is going into a recession, 2020 could be different. But for now, if you don't see the U.S. in a recession and you don't see a big macro blow up from trade war, et cetera, and I guess all kidding aside, we got the Mueller tapes out of the way, we'll see what happens with Brexit maybe, but there's definitely room for risk appetite to return, and we're feeling it.
Great. Our next question is about the U.S. dollar trend. How does the U.S. dollar trend impact your return estimates? Do you still see value if global economic slowing occurs over the next 2 to 3 years?
So sure, this for us, I could give you a two-part answer to this. On the one hand, as I mentioned, the dollar is a headwind to us, although admittedly a lot less than it used to be. Most of our countries don't have, in fact, I've been doing EM since the late 1980s when I started at Salomon Brothers, doing less developed countries back then. So I've watched EM countries for a long time. Today, this is the best I've ever seen collectively, the EM balance sheets. The EM country balance sheets. You've had quite a bit of reserve buildup in places like Brazil and Russia. So you've had trade deficits narrow. You've had fiscal deficits narrow. You've had a lot of improvement at the country level of the EM countries and constituents. So that's one thing that's really important. On the other side of that, volatile currencies give us an opportunity. For example, when the Russian noise happened and the sanctions happened, the Russian ruble got killed. And as I mentioned, the advantage of having these 425 models built, and I'm not going to tell you that we build a model any better than the next person. The reason that we want the analysts to build the models is because we want them to understand almost intuitively what drives their businesses, what drives the company, what moves it. We want them to become near sector experts. And so when a currency is moving, we have these models where we can go in and move the currencies and step on the assumptions and then kind of see where we come out. So in the case of Russia, for example, we ended up buying the big oil names because a weaker ruble was actually very good for them because they were selling oil in dollars. Their cost was in rubles. The rubles were falling. So therefore, they were actually protected from this. So even though the ruble was weaker, we were able to buy a discounted corporate reacting to a weak Russian macro at an even better price because they would benefit from that currency. And so the currency can play itself out both on the micro level from the individual investments in the portfolio, and of course the macro level where it sets perhaps the environment or the tone. But I do want to really emphasize overall, we don't see the stress in the EM. We don't have a fragile five any longer. We don't see the stress in the EM countries that has existed for most of my career.
Very helpful, thank you. Our next question, and we tend to get asked this quite frequently as well, is what is your current China roadmap? How will the weight increase of China A shares in the MSCI EM index impact your portfolio?
So luckily for us, we've actually been investing in A shares for more than a decade. So we've had a couple of A share names in the portfolio, most of them in the hedge fund where it was easier to invest in A shares. We've had at least a name or two in this product since its beginning. And today we have about 5.5 or 6% of that China exposure is in A shares. So we're actually already quite a bit overweight if you looked at A shares individually. And I'll be honest, we lump it all as China risk. I don't know that there's, in our view, there's not necessarily a difference between whether a Chinese name is listed in Hong Kong, in Shanghai, or for that matter, on the New York Stock Exchange or NASDAQ. We look through and look at it as Chinese exposure. But we know that there's a lot of Chinese A-share companies that are undiscovered. There's a lot that are discovered, and a lot of people own generally the same dozen or so names. They don't own all 12, but some subset of those 12 names. And then there's a second and third and fourth wave of literally hundreds of Chinese A-share companies that we're very excited to do the work on. And so I think the A-shares will continue to grow as a percentage of our Chinese exposure. Our Chinese exposure is already at its max. There's a good thing we have guardrails because, frankly, I would probably be even longer China, but the good news is that I'm protected from getting any longer China, and I believe that's a good thing. But what we see from our Chinese companies, from valuation, from execution, from governance, tells us that we've made some very good investments there, and we're very happy with that China weight in the portfolio. And it has been a very big contributor to our outperformance year to date.
Here's an interesting one for you, and you may have touched on this just briefly when discussing some of the currencies. Can EM still be an attractive opportunity if the dollar remains strong?
I guess the answer is yes, in the sense that I'm going to define remaining strong as staying where it is, because I think the market has priced that in. If the dollar were to suddenly start getting really stronger again or go on a big rip, I think some of that risk appetite that I mentioned might get dampened a bit. The dollar making another wave of strength would probably take the wind out of some of the bulls' sails and would become a bit of a headwind for EM. But as long as if the dollar remains where it is, we're not pricing the dollar going up or down we're not really making any judgment in the portfolio on where that goes. So if we can remain status quo, we think that we should be perfectly fine.
And speaking of the dollar, what is Oaktree's opinion on investing in emerging markets in U.S. dollars versus local currency?
So we don't really spend a lot of time per se looking at the currency. Our traders will go and access the investment wherever it makes sense. So if we're investing in a name that has local shares, perhaps an Indian name that has local shares and has ADRs that are in theory in dollars, it doesn't matter to us where they go. We want them to access the opportunity in the least expensive, most cost-effective, non-market moving, because we don't want to have impact while we're building the position, way possible. So we're really indifferent as to where we invest. Obviously, we don't hedge any of those currencies, but if you look at that overall exposure, for example, if our China portfolio is 1,000 basis points, if it's, let's say it's 10% bigger or 10% of our total capital bigger than the 30% weight in the index. If the currency, God willing, were to move 20%, yes, that would cost us 200 basis points of performance, but we don't have any of those moves in our history. It never happens all at once. We often have time to adjust. We could change that exposure from exporters to importers or vice versa, and I think we can alleviate a lot of that by doing the bottom-up work. So we don't spend a lot of time making that macro call other than we want to invest as efficiently as possible.
We've also received a lot of questions on corporate governance. I know we talked about it briefly. Many of the questions that we've received have been about how do we build trust in these teams, in these management teams. Is that something that you do over time, and what does that process look like?
So, look, for us, the trust is there because we've been following these managements for a very long time. The managements, generally speaking, have done what they've told us they're going to do. That's the first thing I would say. The second thing is I do continue to believe it's kind of unfair. I don't think collectively the EM managements have turned out to be any worse than the developed market managements if you look at where scandals are. In the news lately is is it Renault, Mr. Gosen. That's a Japanese/Italian/European company. That's a pretty big issue going on. That's not an emerging markets company. So I think you could find these shaky managements across the entire world. I don't think EM is necessarily any different. The other thing I would add is this idea of ESG. ESG and socially responsible investing is really taking the emerging markets by storm. It's become kind of all the rage. It's a very big, I don't want to call it fad because I don't mean it to be, I believe very much in ESG, and I'm a closet environmentalist, so I'm not by any way poo-pooing ESG. But 9 months ago, no one cared, and today everyone cares. And what's interesting is you could see this when you talk to the companies. So the companies are very aware that we, the investors, very much care about ESG. And so the companies are cleaning themselves up or are working to give us, of course not every single one of them, but many of them are taking a hard look at their board composition. Many of them are taking a hard look at their management composition and insiders versus outsiders and family, etc. Many of them are taking a look at their transparency. Many of them are taking a look at the information they might give on projects that could impact the environment. They're much more forthright with data about accidents and safety records, etc. So the good news is very good for the planet, is this global ESG wave is really also taking emerging markets by storm, and it's forcing our companies to be better. It's doing a lot of our job for us, and we're more than happy. We take ESG very seriously. We have templates on every company. We rank every company. It is an active part of our conversation with the managements, and we are trying to make an impact and engage with the companies just the same. And it's become easier to do that in this environment.
We also received an interesting question about how the growth in China and Europe will impact growth in the emerging markets. Do you think to some extent because emerging markets rely on some of the more developed countries to consume what they produce, do you think much of their growth is tied to the growth of China and Europe and to some extent the U.S.?
Yeah, I think China in particular, I'll be honest, I don't necessarily have a very strong opinion one way or the other on Europe. Sadly, Europe remains a little bit of a rounding error right now in the battle between the U.S. and China. If one is bearish on China, you should sell every U.S. equity you own because China really is what's driving the world. They're some 70% of the iron ore demand around the world. They are a very large percentage of the oil demand around the world. They are, of course, a provider of capital around the world with their investments and their One Belt, One Road throughout Europe, Africa, Eastern Europe, and now Latin America. If you go back and look over the last 4 or 5 years, I think China bailed out the rest of the world. China basically clamped down on overcapacity in commodities, in manufacturing, et cetera, within China, and they took that excess off, and they allowed commodity prices. They single-handedly moved commodity prices back up. And they knew they had to do this because it bailed out a lot of the Chinese state-owned enterprises. And by bailing out the Chinese state-owned enterprises, they made those loans to the banks suddenly become money good. So 5 years ago, you had depressed commodity prices, a somewhat struggling China, struggling SOEs with bad loans to the banks. And so the bank's exposure was there. China basically went out, took the capacity off, tightened it up, made the SOEs stronger, made the corporate loans good, made the bank's balance sheets cleaner, and in a lot of ways single-handedly bailed out the rest of the world by engineering those higher commodity prices. And so I think we are very dependent on China, and therefore if the U.S. economy will go into a recession if China goes into a recession, and perhaps vice versa. But I think we are probably mutually dependent at this point. And the other thing I would just comment on, this trade war. This trade war is not necessarily about tariffs. This trade war is because the U.S. realizes that Chinese technology is winning. The Chinese are far ahead of us in a lot of their R&D. They're spending much more money on R&D. The Chinese will surpass the U.S. in terms of applications for patents in artificial intelligence this year. So they are becoming the dominant technology player across the world. And they've become a little bit smarter about it, and they're much less vociferous about their made in 2025 in China and their China tech plans. But China has a very deliberate and clear long-term plan to dominate technology globally. And whether you like it or not, the lack of freedoms in China give China, the lack of privacy protection, give China a very, very big advantage in data. In the U.S., we perhaps, and rightly so, and I'm not really judging this, it's just a fact, we are going the other way in terms of data, privacy, what we can use, what we can mine. If you go to China and you talk to Alibaba and you talk to Tencent, they will very clearly tell you that, yes, the government sees the data. That's just the way it goes. The government can see your data. The Chinese people don't have the same hang-up on individual freedoms or privacy that we Americans do. China doesn't come from democracy. And so they have a very big advantage. The last statistic I'll give you there, Amazon Prime has, I think today, around 110 million subscribers. Alibaba has 500 million. So their data mining is just dwarfing what we're doing.
And for the sake of time, I'd say let's tackle one more of these questions, and then if anything was not answered, feel free to follow up, let's say using the contact information on this slide. Our last question, how does the ECB's decision-making impact where you will look geographically in the investment opportunity there?
We don't actually, I guess in some ways I don't care. The way that I care is that if the ECB, like the U.S., like the central banks around the world, the ECB is definitely in more of an easing mode and a liquidity providing mode than not. So as long as the ECB stays in sync with the Japanese, Chinese, and U.S. central banks in terms of being in the easing mode, I think it's good overall for the global environment. That easing environment, we do own a Greek bank in the portfolio, so the easing environment has helped. Actually, that bank has become a very good performer recently as Europe starts to clean up a little bit of its issues as the ECB is more accommodative. We don't really have a lot in the Eastern European or smaller countries around the region. So for us, it's much more of the ECB is much more important in the global accommodative or not stance of the world than it is necessarily in opportunities we might find in and around Europe.
Great. Well, Frank, this has been a lot of fun. Thank you for your time. I'm sure our attendees appreciated it as well. And thank you to all of you who joined us today. It's much appreciated. These are some great questions. I'm glad we had a chance to answer a lot of them. I did get a lot of requests for the slides. So for those of you who did reach out requesting slides, I will make sure that we go through and have somebody reach out to you with the information you need. Outside of that, please feel free to reach out if there's anything else you need. And thank you all for attending. Appreciate your time.
Thank you, everyone. Good luck.